All right. Well, welcome to our second event in the Women in Philanthropy series, sponsored by the Office of Advancement and Create Her at the College of Worcester. My name is Carolyn Sergio, and I'm the Assistant Vice President for Development, and I'm also a 2008 graduate of the college. I'm really excited to be joined this evening by Marjan Khazra, a 1987 graduate and current College of Worcester parent, and Colleen LeMasters, a 2010 graduate of the college. Before we do housekeeping items and launch our program, and I know people are still joining, we would like to ask the audience to take advantage of the chat feature and share from where you're joining this evening and include a comment about what you hope to learn by the end of our time together. I will exclude names. You're only going to be messaging the panelists, but I will share some of those comments before we start. So perfect. I'm seeing things come in already. I love it. All right, we are recording tonight's session, and as the audience knows, we asked you to submit questions in advance of the program. Following tonight's event, we will be sending an email that will include both Marjan and Colleen's contact information in case our discussion prompts additional questions and follow-up conversations. At the conclusion of the Women and Philanthropy series, we will send a survey asking for your feedback, and we hope that you'll take the time to complete that survey. We have a wide array of audience members joining us, including current College of Worcester students, graduates ranging from the class of 2020 to the class of 1964. So a friendly reminder about tonight's content: no two people's financial situation is the same, and therefore advice and recommendations should also vary. For that reason, we did share our disclaimer in advance that reinforces financial conversations are not one size fits all. As I mentioned, we are partnering with Create Her, which is an initiative of the Center for Entrepreneurship, and whose mission is to inspire women to become leaders in both their professional and personal lives through education and mentorship. If you are interested in becoming a mentor, our new Fighting Scots Career Connections platform is the perfect place to start. We already have more than 1,300 alumni advisors on the platform waiting to connect one-on-one with fellow alumni, but more importantly, to provide connections for current students and recent graduates as they launch into their career paths. We also have a specific Women in Philanthropy group as the result of the series. So thank you for your chat responses. It looks like, oh my goodness, we have people all across the country. This is wonderful. Virginia, Tennessee, Washington, Denver, Houston, California. This is great. I really appreciate it. Let's see here. It looks like we are getting also some great comments. A lot of people talking about wanting to have a little bit more financial freedom, taking off my investing experience. This is perfect. Really looking forward to diving into this topic. This is great. Thank you so much for joining us this evening and providing some feedback. This is great to see so many people joining from across the country. Our panel will take the shape of a question and answer format, and our goal is to really take advantage of Marjan and Colleen's expertise in financial planning and discuss the variety of financial planning stages that are represented in our audience. If you tuned into our first event in the series, which was a research-based presentation from the Women's Philanthropy Institute at Indiana University, you likely heard about the ways men and women differ on how they approach giving. Their research shows that women's wealth is rising, women are more likely to give, but unfortunately, women are also paid differently than men. To be exact, women earn 82 cents for every dollar men earn, according to the United States Census Bureau. This discrepancy in pay only increases when we look at pay for women of color, with numbers dropping down to 62 and 54 cents on the dollar for Black and Hispanic women. Similarly troublesome is that women hold almost 2/3 of the nation's student loan debt, and Black women often graduate with the heaviest burden. We will certainly be discussing managing student loan debt this evening, as it happens to be one of Colleen's areas of expertise. Another area of focus for this evening involves retirement planning, which is obviously a very critical topic. It's important to understand that because women are often hired into manager level positions at a slower rate than men, positions that do traditionally pay more, this contributes to the problem of having less to invest long term. The statistics are startling. Vanguard reported in 2018 that the average accumulation in a workplace retirement plan was 131,000 for men compared to 88,000 for women. As I'm sure you've heard or even might be experiencing yourself, the financial impact of the pandemic on women is also very real. According to a December 2020 New York Times article, women have been disproportionately impacted by job loss, being hired less, and have spent more time away from the workforce caregiving. Even these brief career interruptions diminish long-term wage growth, retirement savings, and Social Security benefits, which are determined by wage history. The gender wealth gap is complicated, but we can make a difference by making our finances a priority, by lifting up women, by being intentional about which businesses we support, and frankly, by how open we are with each other about traditionally uncomfortable topics like money. Most importantly, and certainly in line with Worcester's value of creating lifelong learners, we must educate ourselves about matters of personal finance. So let's learn together from the experts. Marjan Khazra brings 3 decades of experience in the financial services industry. She works closely with business owners, executives, and high net worth individuals and families to help them make proactive financial decisions to achieve their long-term goals. Marjan specializes in building customized investment portfolios designed specifically for each client's unique financial situation and risk tolerance. As a managing partner of Flow Financial Partners, Marjan also manages the ongoing compliance regulations to ensure Flow Financial Partners is compliant in the ever-evolving regulatory landscape. Marjan completed her undergraduate degree at the college and then went on to receive her MBA from Thunderbird Garvin School of International Management. Welcome, Marjan.
Thank you.
Colleen LeMasters is an investment advisor representative and insurance professional with B.A. Schrock Financial Group. Colleen's passion is creating retirement income plans that help clients optimize the entire range of retirement vehicles, including Social Security benefits, pension, and tax planning. She also specializes in student loan planning. After graduating from the college, Colleen followed her talent for numbers and began working in the insurance and financial services industry. It was during that time that she discovered her love for personal finance and eventually transitioned to B.A. Schrock Financial Group in 2014. Colleen passed her Series 65 securities exam and holds several life and health insurance licenses. She has her bachelor's degree in business economics from the college, and in 2020, Colleen earned her Chartered Financial Consultant designation. Welcome, Colleen. Before we move into the formal question and answer section, I'd like to actually start by asking both panelists to share their personal thoughts on why this topic is so critical to discuss and what inspired this line of work. So Marjan, we will start with you.
Thank you. Thank you for having me. Basically, as you mentioned, I've been doing this for 30 years, and I graduated in 1990 with my MBA, and during that time, the job market wasn't that great. I had got a job from graduate school straight on with American Express, and it was in California. I grew up in Ohio, so I was like, you know, what's there not to do? And drove out to California, started the work, not knowing what I was getting into. And it was an eye-opener. It was a corporate environment. It was during that time, the good old boys, if you would want to say. They had an amazing training program. Out of my class of training at American Express, I would say there was maybe about 20, 24 of us. There was only 3 female. And the 2 of us were from the same grad school, so we started together. I had one lady that had started the program maybe 2 or 3 months ahead of us, and that was it. During the whole year that I was there, that was it. And I have to give credit to Worcester and the IS, and the community at the college, where it made it very easy for me to talk to my professors, you know, and in the IS, where you independently worked with them, with your professors, and you met with them one-on-one, and having to defend my IS in front of the whole department really gave me a leg up, I believe, in terms of being able to go talk to the managers and be like, there needs to be certain changes. And there were some changes as much as they could. Again, this was a big corporation, so as what they could at the level that we were at. But one of my first clients I remember, which I had inherited, was an elderly lady, I would say in her late 80s. This is back in 1990, 91, we're talking about. And her husband had passed away. She didn't know how to write a check. And that on top of not having any women in management, 3 women out of a whole class in the training group, really was eye-opener to me in terms of, this is an area where I think I can really help and be beneficial to women, to everyone, but especially to women. So
Marjan,
there I've been 30 years.
it turned into a career. It stuck.
Yes.
That's wonderful. Thank you for sharing that personal story. I really appreciate that. Colleen, what about you? What inspired this passion, or what inspired this line of work for you?
Yeah, so really I've always had a love for numbers. Math has always been my strong area for some odd reason. I loved it. But when I was in college, my parents actually decided to file for a divorce, and my mom had never really managed the finances. They had been married for over 20 plus years. So I truly wish, if I had been paid a little bit more attention, or maybe had known, more about what was going on, but I was in school, wasn't really paying attention that much. I was, 18, 19 years old, but I truly wish that she had sought out an advisor to guide her down the right path, because she would be in a much different situation than she is today. So really that's what drove me, I guess, in the financial services industry, was to really help out those, help out individuals just like my mom, who made those bad financial decisions early on. Like we had just talked about, Carolyn, all those stats that you gave, the topic is very critical to discuss, because I feel like in financial planning, women are often left out of the conversation. I can't tell you how many times I'll have, no offense to men, but I'll have them come in and be like, my wife doesn't want to talk about this. And I'll say, no, you need to bring your wife in next time. Okay. Because it's very important that they know their plan too, whether you're married, single, divorced, I've seen it all happen. I've had clients, their husband passes away, and now all of a sudden they're having to manage the finances. And women are living longer than men. So they should at some point in time realize that they're going to have to manage their finances. So, my job truly is very rewarding. I love coming to work every day. I love helping people. We truly get to help people in our profession every day and make a lasting impact on their life. And, I love it when my clients send me like pictures of themselves at the beach because they retired, or, little things like that. That makes my job very rewarding. Or, they got to go see their grandkids, birth of a grandchild, so super rewarding. And I always tell, every woman that comes into my office, if you don't have a written investment plan, it's not investing, it's speculating. So, I think it's very important that we as women have that written investment plan, or that plan that you kind of know, hey, these are my goals and objectives, and this is how I'm going to achieve it. So yeah, that's really what inspired me. And I'm glad to be on here with everyone today.
Yeah, thank you, Colleen. Again, thank you for such a personal story. I think it really helps set the stage for what we're trying to accomplish in conversations like this. I just want to pick up on, I really appreciate the idea of your partnering with individuals to help them achieve a goal, right? And having that conversation about where do we go from here is really important. Colleen, for our first question, so now we're going to get to the tough questions. We'll get into the meat of the program. We will stick with you for our first question. And it's a good starter topic, certainly for the current students and recent graduates. Student loans obviously are a very hot topic for a variety of reasons, but for the purposes of our conversation, what do you recommend? What is your recommended approach to managing that student loan debt? And of course, just as importantly, how do you manage that while you're trying to think about retirement and establishing emergency funds and simply just meeting current financial needs?
Yeah. Well, I guess how long do I have to talk about this? I'm kidding. So I'll try to keep it short. Yeah. I'll try to keep it, short and, to the point, because obviously everyone's situation is so different. So really, if, you as an individual, if you have student loans, which the majority of us, probably at some point in our life are going to have student loans. It's just, the cost of education is just outpaced inflation. So, more than likely at some point you are going to have the student loans. And I do believe that student loans need to be included in the financial plan. So I'm going to use a real life example, because I always like to tell stories for people to, truly understand, why you need to constantly evaluate these things. And I'm going to use my own example over the past 10 years, my own student loan journey over the past 10 years as an example. So I moved to West Virginia while my fiance, now husband, was in med school. I started my own, we got married. I decided to go into independent financial advising and cashed out my 401k to help support myself for a few months. I know no one cringe yet. Something that we tell people, not to do, but I wanted to take a shot on myself. We bought a house. We have, 2 handsome little boys right now. And my husband, finally finished his residency here in the middle of a pandemic in 2020. So, and he started working in the ER as an attending physician. So, wow, that's a huge lot of changes over the past 10 years. So on that student loan strategy came, a lot of things that have changed. You're going to be borrowing as an individual. I had private student loans, so there's not a whole lot that you can do on the private student loan front other than look to, go to a private refinance. Okay. Now, and potentially get your interest rate lower, because I just, I refinanced mine a couple of years ago and got them much lower than what I had borrowed at originally. So that would be something that we would evaluate and say, does it make sense to refinance? And then from there, you're going to have your federal loans. So federal loans are obviously another animal. And if the pandemic has taught us anything, it kind of says, I favor that my clients take out federal loans if they are, going that route for education. So what we would do is really figure out, more than likely a lot of the client, people listening on this, I should say on this webinar today, took out loans recently. So what we would do is find out what is that payment going to be for you. So whether we're going for a public student loan forgiveness, are you a teacher? Because there's a lot of different loan forgiveness programs for teachers. Are you going to be a doctor in a low income area where there's other, subsidies for your loan? So there's a lot of things that I guess go into that public student loan forgiveness. But the key is that you have to make 120 qualifying payments. And then whatever that balance is forgiven at the end of those, pretty much it's 10 years. Well, the one mistake that I see people make is they don't fill out that employment certification form. And you need to fill that out every year. Okay. Every year when you recertify your income-based repayment, you need to refill that out. The next thing is, for others that have borrowed a large amount, we will also look at, that there's also 20 and 25 year loan forgiveness programs. Okay. So on the 20 and 25 year, depending on what years we borrowed, that determines the 20 or 25 year loan forgiveness. So that's also going to be an important part to take a look at. But the thing is, we also have to plan for a tax bomb for the 20 and 25 year loan forgiveness. So whatever that balance is at the end of 20 and 25 years is actually viewed as taxable income to you that year. So, you could be reporting, $100,000 in student loans, forgiven on your taxes that year, which definitely could, we need to make a plan for that. So usually we would open like a brokerage account in that situation to make a plan for that tax bomb come 20 years down the road. There's a lot of talk about, different types of loan forgivenesses, coming up. I'm not going to go down that road tonight because we could be here forever, but for sake of discussion right now, most of us are going to be capped at that 10% of our discretionary income for our family size. So that's your max payment is 10% of your discretionary income. And the way that they're going to calculate that is they're going to say, you have, a family size of 2, if you're married, they're going to take that family size times 150% of the poverty level and subtract that from your gross income for the year. So whatever that dollar amount is times 10%, that's what you're going to have to pay for the year in your student loan payment. Now, meanwhile, your loan could be might just be paying interest on your loan. So that's just where we get into that, are we eligible for those different things? So once we've kind of figured out that loan payment piece, then we kind of go into, on the second part of the question was, how do you manage this while trying to do everything else? So I'm a big bucket person. So, we have our student loan bucket. We kind of know what our payment's going to be. And we can project out like, hey, if I get married, if I have kids, what is my payment going to look like as it adjusts throughout my life? And then we also have our, 401k bucket or 403B bucket. So I always recommend, the moment that that you get a job, you take advantage of that company match, because that's free money and you're leaving it on the table.
Yep. And
I've seen too many people make a mistake where they don't take advantage of that free money that's on the table. So we would do that, and then after we've, taken advantage of the company match and maybe putting in 3 and the company's putting in 3, we will go out and then establish an emergency fund. Okay. An emergency fund is very important to have. And I think the pandemic, if it taught us anything, we should be relying on that. We should have an emergency fund. We can't just depend on the government, even though it has happened, to send us stimulus checks. We need to depend on, you need to have some money in your account to be able to, help you out for a couple months. So rule of thumb, basic rule of thumb, is if you're a W-2 or a wage earner and you work as an employee for a company, about 3 months of basic living expenses. If you're self-employed, you should have about 6 months of living expenses. And then, next, after we kind of have that emergency fund established, we'll establish like that house, I call it like my house fund, essentially. So, usually the next step is I want to buy a house, I want to be a homeowner. So how do we do that? We start, I usually have my clients will open a savings account, whether it's at Ally Bank or, it's one of the online savings accounts that are paying paying a little bit more than your brick and mortar banks. So Ally or Marcus, they're paying about 0.4% right now, not anything to write home about, but, it's FDIC insured and, we can put money aside in there for that house down payment then on that side. So that's really how I like to, structure it once we've figured out that loan payment piece.
Perfect. Thank you, Colleen. All of a sudden, I have become very grateful that we're recording tonight's session because I can't find my pen fast enough to take notes. So this is perfect. Thank you. That was very helpful. One of the things that you just mentioned was about the different types of accounts, obviously associated with savings. I'm actually going to toss this question to Marjan. And one quick comment, I noticed that we are getting a lot of really wonderful questions in the chat. Many of them will be incorporated into some of the questions we already have outlined, but if we don't get to them, we will either try at the end or we will follow up at the end of the program and share both Marjan and Colleen's contact information so we can continue that conversation. So if we don't respond, it's just because we're going to keep flowing through. So Marjan, we actually had a very specific question submitted by a 2009 graduate, which touches on some of these subjects about, essentially what is the best way to grow wealth over time? The specific question was, besides a Roth IRA and a 403B retirement plan, where can I save my money where it will grow? A brokerage account?
So just to follow up on what Colleen mentioned earlier, the different buckets, those are the exact perfect way to do this. And again, what she mentioned is, first, I would max what I can in my employer's 401k. It's free money, as she said, if they match. Even if they don't match, it reduces your taxable income. As well, they're actually cheaper because the company, especially if you're working for a larger company, they're picking up a lot of the expenses. So it's actually becomes cheaper for you than actually going through an advisor and getting advice. So that's my number one, is to maxing out your 401k, your 403b, whatever the company does. And I hear sometimes people say, well, I only do 3% because they only match up to 3%. I'm like, well, do you have more room, more discretion? Like, oh yeah, I could do more. I'm like, why don't you do the 6 or the 10% up to where you can actually do it? With the larger companies, what they've actually done now is they have age-based, meaning you can invest in the fund, so you don't have to, a lot of times people are like, oh, I'm afraid to invest because I don't know what to invest. So they've made it easy for you. They have funds that say 2040. What that means is you're going to retire in the year 2040. So it becomes a little bit more aggressive because you've got another 19 years to do that, or 2030, which is a little bit less aggressive. And you can actually split it up. You don't have to put 100% in 2040. You can split it up. And that way someone else is actually watching over your retirement accounts instead of you worrying about it, especially essentially since there's really not an advisor that's watching your 403b or 401k. So that's the first place I would go. Again, on Colleen, emergency fund. You really, and that is a savings account. I hate to say it. You don't want having an emergency fund in the stock market, and the stock market tanks 20%. So it is, although right now they're not paying anything. You do want, as she said, 3 to 6 months of your fixed expenses in a savings where you can actually get hold of. Roth IRAs. I love Roth IRAs. If you can qualify for a Roth IRA with your income, definitely do it. For the next thing is depending on what you're trying to save. Yes, a brokerage account would be great if you want to dabble into stocks, bonds, mutual funds. That would be one option. Again, I know we have a wide range of ages here. People are also saying, you know, I've maxed out my 401k and I want to save more for my retirement. A non-qualified annuity works like a 401k where you're investing in it now. It does grow tax deferred, and you have to keep it in there till you're 59 and a half. Then you can start. You don't have to annuitize it with the new annuities now, which a lot of people are afraid of. You would have to annuitize it in the past. Now you don't. You can take income, you can take chunks, and you just pay that taxable income, hopefully when your tax rate is lower at retirement. So that's an area where people can actually take advantage of if they're trying to save more for retirement and they've maxed out their 401k. But the Roth IRA, if you can max that, it's one of my favorites.
Marjan, can I ask a quick follow-up question? You mentioned if you can qualify for the Roth, what should people be aware of in terms of being able to be eligible for the Roth IRA?
It's your income. So there's a range of income that you can do. So you can work with your accountant, you can look it up depending if you're single or married.
Perfect. Thank you. That was a great response. Now it's in my brain. 3 to 6 months, and we're answering one of the questions in the chat. Put your emergency fund in a savings account, not in the market. Okay, yeah. Perfect. Now we can go on to our next question. Thank you, Marjan. Colleen, this one is going to come back to you. So similar to the sort of the last question with a little bit of a tax implication twist, a 1993 grad submitted a specific question, which was, when you and your spouse have to file separately, what's the next best investment from a Roth IRA?
Yeah, so we actually use this a lot. And, you know, this can also go for people that don't qualify for Roth IRAs too, kind of my answer for this as well. So if you make too much money and you can't contribute to a Roth IRA, first option we look at is it's called a backdoor Roth. So essentially you can contribute to a non-deductible IRA and then convert it to a Roth IRA in the same year. Now, there are some caveats around this, and I always say we want to get a blessing from a CPA before we do this, because if you have other IRAs out there, it can get kind of funky on that. So that is something that we would look at doing. The key is that you have to do it by December 31st, you know, every year. You have to do that contribution and conversion by December 31st versus waiting till when you file your taxes. So you definitely have to really know your whole income picture when we sit down and talk with the accountant. You know, another idea, you know, especially on that, you know, if we're really looking for like that tax-free savings, you know, we do a lot of brokerage accounts. I would recommend that you do, you know, maybe we look at a brokerage account if the backdoor Roth is not an option for you. And then, you know, we practice what we call tax loss harvesting inside that account. So the idea of tax loss harvesting is you sell a stock for a loss, so you realize that loss on your investments. And then essentially you wait 31 days to buy back into that stock. So you're able to realize a loss on your investments there and kind of write it off against some gains inside of it. So, you know, we did that with BP back in March, April for a lot of our clients, sold off BP because it was down a lot and then bought back in. So that's just one example of, you know, how that account can be very advantageous. The other reason why it is very advantageous too is because long-term capital gains right now. So as long as you hold the stock for, you know, 300, we'll call it 66 days. So 1 year, 1 day, you know, you can be taxed when you sell that anywhere between 0% to 20%, depending on where your tax bracket is. So, you know, for a lot of our retirees, if they've held this account for a long time, it's very a tax efficient vehicle for them in retirement. And there's also no 59 and a half age restriction. So you can actually access it before you're 59 and a half, not have that 10% tax penalty. The last option is if we truly want to create like that tax-free income for you in retirement, you want like that Roth, you know, type distribution. You know, we would go and look at like a permanent life insurance policy, like a variable universal life or an index universal life, and, you know, fund it for a certain dollar amount and then take out tax-free loans from that policy. in order to help supplement your income in retirement. So, that one too is another interesting one that, we're able to really max fund these things right now, just because of some recent law changes as well. So we're definitely utilizing that for some higher income earners as well right now.
It's interesting. One of the things that we often talk about in our world, in the philanthropic world, is encouraging people donors to make gifts of stock, right? Because they can't bypass those capital gains, and we are watching closely to see what happens. And there are, potentially financial implications for how people might change their giving because of those those advantages. So certainly, that's perfect. Colleen, really quickly, I'm going to ask one more clarification. When you talk about a brokerage account, can you give like the 30-second elevator pitch to make sure everyone is on the same page in terms of a brokerage account?
Sorry, yes.
No problem.
Brokerage account, think of it like you're checking your savings account. So money you've already paid taxes on, that, like you've taken home in your net paycheck, and that you are investing then in the stock market, essentially. So you are taking that account and you're investing it into stocks, mutual funds, bonds, exchange traded funds, whatever. So
perfect. Well, okay, so I'm going to continue with you one more question. I'll go back to Marjan. One of the common themes that we saw in our pre questions was, what are some sort of low commitment ways for people to get into investing, and of course, are there any recommended apps or I know there's a lot of trendy conversations around Robinhood and others, but what are your thoughts on low commitment investing?
So I guess I would say, what is the low commitment investment for, first off? So, truly, if it's meant to, I think Marjan said it best, like if this is meant for an emergency fund, you're not going to be investing it in the stock market. There's no point, because that's there for an emergency. We can tell, our clients like, hey, maybe now's not the best time to, liquidate some stuff. Let's look at something else or look at a different option, while the market recovers. So when it comes to, low commitment investing, there's tons of, options when it comes to well-diversified exchange traded funds, that we can get into for, 10, 15, 20 bucks a month, $100 a month. There's plenty of ways to structure it. I'm not a huge fan of some of the apps, and I may just be biased because I'm in the financial planning industry, but I think they set a lot of people up for unrealistic expectations in the market. So whether it's, because a lot of times people go on Robinhood, for example, and buy, I'm trying to think of a crazy stock. They'll buy GameStop. Okay. I said it. So they'll buy GameStop at a high, and then they get a bad taste in their mouth because it lost, 30, 40%. And they're like, I'm never going to invest in the market again. And that's because they put, all their money into one stock. I kind of call it like the lottery effect, like you're trying to win the lottery, you're trying to make all your money and it's going to make you rich and you never have to work again. That's pretty unrealistic when it comes to investing. So you do want a well-diversified portfolio, in different asset classes and different areas. So I do think that, some of the platforms do set you up for some unrealistic expectations and not a well-diversified portfolio for you to help, achieve those goals that you want to later on. So I would truly recommend, getting in touch with a good financial professional that can help you diversify that.
Absolutely. And I'll actually specifically ask that question a little bit, but in the realm of risk, Marjan, I'll send this question your way. And certainly in part because you have, you're part of your expertise is helping your clients understand that risk associated with their investments. Remembering that we have a variety of age groups on the call tonight, can you talk through how you sort of advise clients on how much risk they should be taking in their portfolio?
Sure. So one of the things that actually is very hard, and we don't do the risk, each individual person has a different risk tolerance. We have clients that are elderly and they're very risky, and we have clients that are young and they're very conservative. So risk, I believe it's a personal thing. As long as you individually meet with a financial advisor and say, this is where my risk is, I'm okay if I lose 10%, I won't freak out, then we can work with that. I always tell my clients, as long as you're not up at night worrying about your accounts, then you have the right risk tolerance for your account. If you're constantly worrying about it, then you're probably the investments are too risky for you. If you're looking at it on a daily basis and you're seeing the volatility of it. So risk definitely with us and how we meet with our clients, because we do assets under management, we take their assets and we manage it. It's a one-on-one conversation. And we have situations where the husband is more risky than the spouse, or vice versa. So you've got to meet with both, as Colleen said, and find the right medium, or you have different accounts with different risks. So they're both comfortable with it.
Yeah, it's not one size fits all, certainly. I really appreciate that perspective. I know in my own personal experience, my capacity for risk really shifted with with my age, but also with life events. After having 2 children, I thought, we should be a little bit more careful. And so certainly it takes an in-person conversation. Kind of along those lines, in terms of planning for the future, Colleen, when you're talking to clients about that future planning, especially considering caring for family members, whether it's aging parents or younger family members like children, how do you make sure you help clients have adequate financial coverage, right? So whether it's disability or what are some of the insurance options, how do you kind of approach that conversation?
Yeah. So, really, when people are starting out, young people, young families, I usually recommend 10 times their earnings in term insurance. So that's kind of like a good rule of thumb. And then we don't have to go back and like add more on if you have more kids. It kind of just covers the whole thing. When it comes to disability insurance, I think it's very, very good to look at what your employer's disability coverage is. And especially for women, I know maternity leave is like a big thing for women to talk about. If you're a sole proprietor, you're not going to, there are no policies, because I looked for all of them. There are none, that will pay for maternity. So you're pretty much going to have to plan for that on your own and save for it in that savings account that we've been talking so much about. But disability insurance is also very important. So for those of us that don't really understand how disability insurance works, that's going to be what's, going to pay us out if we ever become disabled or, become sick and we can't go back to work for a period of time. So short-term disability will typically last, anywhere, usually about 3 months. Sometimes it's shorter. It depends on the company. And then we'll also have the long-term disability. So it's very important to long-term will usually pay you about 60% of your gross earnings. So around 60% of what you're making. And obviously they're not going to pay you the full 100% because they want you to go back to work. Okay. Short-term disability will typically pay around 70%. I know some companies will offer you like a buy-up option where you can pay, where you can actually pay to have like a full 100% on the short-term disability. So we always evaluate that as coverage. So like, especially in sole proprietors, or for example, because I do work with a lot of doctors, we'll look at it and say, hey, your company's only offering you, $5,000 in long-term disability coverage. You have this big gap. So we'll have to go out and actually buy what we call an own occupation then at that point. So an own occupation says that if you can't, do your actual job, but you go work somewhere else, they're going to still pay you out that dollar amount, whatever that dollar amount is, $10,000 a month, for example, for as long as you can't be in your specific occupation. So that's something else that we would look at for an individual there. But yeah, life insurance is always good to have. I kind of started in the life insurance industry. So I always tell people I have a love-hate relationship with life insurance, but I do see the importance of it. I've actually seen it, unfortunately, pay out and actually help clients, whether it's, when their spouse has passed, we've been able to pay off their house, put them in a much better financial situation. And that's truly what it's there for the unexpected. When the unexpected happens, it's there to help you get you through that tough time.
Yeah, I think describing your relationship with insurance, life insurance, as love-hate is perfect. I had a colleague who'd always describe it as Baskin Robbins, right? 32 flavors worth of insurance policies, and everyone was just as confusing as the next. So yes. Obviously it's a situation where seeking advice is really important because there's a lot of different options and you need to find what's right. My next question, and I promise this is not a plug for support just yet, but one of the things that our office, in addition to obviously promoting stock giving, that we have really seen an uptick in is qualified charitable distributions to the college, right? And so my question is, can you talk through, and so of course this is like, on the other end of the spectrum from student loans in terms of more on the side of retirement planning, but can you talk a little bit about the ways people should be thinking about taking advantage of opportunities, for example, like a QCD, so they can kind of avoid maybe bumping themselves up into a different tax bracket when they have required minimum distributions?
Yeah, definitely. Actually, you guys are, again, this might be a topic where I might ask how much time do I have?
Oh, no.
We do talk about this a lot in our seminars and workshops that we give publicly, especially in regards to when a person turns 72. So for those of us on this webinar today, government recently changed it to 72. When we turn 72, you're required to take out money out of any pre-tax account. So a pre-tax account can be a traditional IRA, a 403B, 401k, 457, a deferred comp plan. All those are that. Roth IRAs do not count towards this. So that's also an advantage of having a Roth IRA, okay? Because you don't have to take out a required minimum distribution. But when an individual turns 72, the government states that you have to take money out of this account. And every year after that, you have to take money out of it. And it's actually a dividing factor. So it starts off at around, and they're just actually changing the tables for next year. So I don't have my first two numbers memorized yet, but it used to start off at 25.4, or for this next year, it starts off at 25.4. So they'll take your December 31st value and divide it by 25.4. Okay. Whatever that dollar amount is, that's how much they have to, that's how much you have to take out of your IRAs that year, okay, out of your individual retirement accounts. So that's what your required minimum distribution is. An important thing to know is that every year after that, your dividing factor actually gets smaller and smaller and smaller. So therefore your distribution gets larger and larger and larger. So as you can see, hey, it's great, your account's making money, it's growing. But at the same time, the government's telling you to take more and more out, to where when you're in your 90s, you're having to take out about 10%, about 10% of your portfolio per year. So, I see this a lot. A lot of couples or individuals are fine tax-wise until they reach that required minimum distribution age. And because, they maybe have been living off of Social Security, they were fortunate enough to have investments, they have the pension income coming in, and they never had to touch their portfolio. So it just grew. And then at 72, this bomb kind of goes off. So, I'll kind of use an example because I'm, like I said, big story person. So, and especially the other important thing on the qualified charitable distributions before I get into my example is that you can do up to $100,000 per individual in your family. So if you're married, you can actually, you and your spouse, depending on if you guys both have IRAs, you can do up to $100,000 per those guidelines. So I'll give you an example. A married couple, I recently met with, was bringing roughly $60,000 a year in fixed income. Okay. So that was we'll just say about $40,000 from Social Security and $20,000 from a pension. So the unique thing about Social Security is that it can be taxed at 0%, or it can be taxed up to 85%, can be viewed as taxable income. So most people will fall kind of in between there, depending on where they are in retirement. After I ran them through this exercise, we kind of figured out in our tax planning software that they were going to be reporting in retirement an adjusted gross income. So this is after, before you do your standard deduction and figure out how much taxes you're going to owe, of around $24,000. So after my discussion with them, I found out that they gave to their church and various, other nonprofit organizations. So we were estimating that when they both turned 72, that they were going to have to take out $30,000 out of their, combined out of their IRAs. Okay. So, imagine, another 30 on top of the 60 that they're bringing in. Okay. So that additional $30,000 in income was going to have them, remember they were reporting 24,000 as their AGI, is now going to be actually reporting 78,000 because of that, how Social Security is viewed as taxable income. That's a whole long equation on that one. But So what we did was we found out after I kind of figured out that exact dollar amount, I showed them a way that, hey, by using the qualified charitable distribution, as long as we send it directly to the institution, we don't have to report it on our taxes. So it's better than it hitting their checking account, or essentially them taking the distribution and sending it then to the institution, because they get the deduction, but it's not as nice as not having to report it on your taxes. So in this example, again, they were at 78,000 doing it the way that they thought they wanted to do it. And then we showed them a way, hey, by doing this $5,000, direct distribution to the causes that you feel passionate about, we were actually able to lower their AGI, or their adjusted gross income, down to 68,800. So, I mean, by doing that, they saved $9,000 of reporting income on taxes just by that slight strategy. And you can see, the higher your income gets, the more you're going to be kind of saving dollar for dollar on that piece. So again, before they had to take out that required minimum distribution, their adjusted gross income was at 24,000. Before they kind of talked to me or, met with our office, their adjusted gross income when they reached that required minimum distribution age was going to be 78,000. And then we were able to show them a way to get it down to 68,000 by just by doing that qualified charitable distribution. So that's the advantage of utilizing that. Cause I know a lot of people give to their churches, church, obviously College of Worcester, other places, so they're giving, they are giving back, but let's do it in a more efficient way.
Yeah. Thank you, Colleen. We see probably about 100 QCD gifts every single year. So it's certainly something that a lot of people are already taking advantage of. Mm-hmm. Marjan, in that same sort of tax related and planning theme, when you talk to clients, how do you help them think about leaving a tax efficient legacy to the next generation, right? So that legacy planning piece of your work.
We work actually very closely with estate planning attorneys here in the area, and that's what I would recommend. Tax laws change. This new administration, there's in talks of changing it. Okay. So, we are really looking closely to that. The charitable qualified giving that Colleen and you guys were talking about is the best way. We've seen an increase where we are actually having the clients send it out of their IRAs, or directly to a church, a school, or where they wanted to go, and then it's more tax efficient. One rule that changed with the CARES Act, that's where the 70.5 was moved to 72, is as a spouse, if your spouse dies, as a spouse, you inherit your husband's or your wife's account and you keep it as your own. Your child used to be able to keep it and take out a portion during their lifetime. Well, that's been taken away. So now if you were to die and you're single, your child, and say you have $1 million in an IRA, that child has to deplete that account within the next 10 years. So depending on how old that person is, how much income they have, that's a huge tax, liability right there. So one of the ways we're actually seeing clients do is, on top of the charitable donation, is they actually name the charities as the beneficiaries to those IRA accounts, where they say, it's going to really be a tax burden on my kids. They don't need it. They will do that directly to a charity because that's what it looks at now. Who knows what it's going to be 5 or 10 years. So you have to continuously read up on these tax laws and have the, like the College of Worcester or, USC as your beneficiary of that. And a way around this is to also do second to die insurance policies, which maybe Colleen can elaborate a little bit more than that, where you're gifting to your, to a child and they're paying the insurance. And then once the insurance, pays out, they would pay for the taxes of the estate and everything there has to be. That's one. We do generation skipping, where you actually skip your child and you give it to your grandchild. So again, those are the types of trusts that we see. Charitable remainder trusts are big with our clients, where they, will do that. Charitable family donations, so there's a lot of families that will set up their own donation And they can do that. And that's easily done with companies such as Fidelity, where we were with that. And you donate to that, and from there, you can donate to charities.
Yeah, Marjan, you're in a state where donor advised funds have just skyrocketed, obviously given part of the Silicon Valley's pumping of money into those donor advised funds, but they're really wonderful planning vehicles for sure.
They are. And again, depends on, as you mentioned, exactly what state you're in.
Right.
It depends on your taxes. It's huge. So you really need to work with an attorney within that state to help you to become tax efficient on that.
Yeah, California and New York are our more complicated ones that we on our end for sure. So you're in it. One of the questions that's come through in advance and certainly coming through our chat right now, and Marjan, I'll stick with you to start off. People are looking for more information about, why is this valuable to partner with a financial advisor? If the last 50 minutes haven't taught me anything, other than I might want to think about a female personal financial advisor, but can you talk a little bit about, when it might be the appropriate time for someone to partner? And can you just talk what that process looks like? And if you're able to elaborate on sort of like a fee structure, for example. Marjan, do you mind starting?
Sure. Anytime is a good time. There's all different types of advisors. They could be hourly. A lot of times the first meeting is free. Just do a complimentary meeting just to see where that is and maybe refer them out to someone or not. So I think anytime's a good time, because a lot of times I believe people will not invest because they're afraid of not knowing where to invest. So actually speaking to someone could help. This is what I can do. I remember when my brother graduated from College of Worcester, I told him to invest $50 a month into a mutual fund. And he was like, $50 a month. And after 3 years, he called me and he thanked me, because even $50 for him might have been too much, but it added up, especially if you're in the market, it added up. So, even little stuff like that, I think an advisor can help you, depending on where you are, and I know we have a wide range of age groups, and I'm sure financial in this chat is a good time. The way my firm works is we obviously have limits. We have different advisors in the office. So we have clients that have double-digit millions with us. So we're only charging 0.3% to manage their money. Anything about 1.5 to 2 million, we charge 1%. And I think below that, which we have another one, is 1.5%. So 1.5% is the maximum. And we always say we're sitting on your side of the table. So if your accounts grow, so does our income. So we're not looking for the next, commission or anything like that. So that's how my firm works.
Perfect. That's very helpful. I think you just answered like a matter of 4 different questions that have popped up in the chat box. So thank you. Colleen, did you want to add anything to that?
No, I mean, we have a pretty similar structure here, on that fee, like we're a fee-based advisory firm. So definitely on the fee, we wrap a fee on the assets that we manage, and we do tier it based on the asset amount that we have, that the person has. And, I do carry an insurance license, which to the SEC is a conflict of interest. So I do have to disclose that. And I also, have to disclose what my commission is when I do sell an insurance type product. So that's the main difference really on that front. But we're very similar structures there.
Perfect. Thank you. Well, we are quickly approaching the end of our time. So before we wrap up, I did want to ask for, a more philosophical question. We've had a lot of specific questions around obviously tax and planning. And so I guess, my question, and I can form my own opinion after hearing the wonderful feedback, but when you think about maybe giving advice to young people or people at any point, right, and it's not too late to start, what does it take to be a successful investor? Can you talk a little bit about what have you seen worked well? Colleen, do you mind starting?
Yeah, to be a successful investor, and I think it's really, Marjan kind of hit it with the risk tolerance. If you can sleep at night and not, worry about your portfolio. Cause I mean, that's the number one thing, like I can tell you right now, I am a very aggressive investor, but I also know the stats and, I'm okay with seeing my portfolio swing a lot. But again, you have to be okay with looking at that statement, long-term. But I think what makes a person, a really successful investor is being, saving on a monthly basis, just continuing to save and being a good saver. Because for women, it actually is more important that we save, more of our income than men, because we're living longer. And you're still going to require, you're actually going to require more of your portfolio, because our Social Security benefits are often less than your spouse potentially. So we are seeing that, and I think that it's very important that, just saving on a regular basis and making sure that you're not just throwing it all under your mattress, that you're actually investing in the stock market, because that's been the one thing that's kept pace with inflation and actually outperformed inflation.
Perfect, Colleen. Thank you. Marjan, I will hand it over to you. What do you think it takes to be a successful investor?
I absolutely agree with what Colleen said. You got to do it on a monthly basis. That's also called dollar cost averaging in our industry. So by investing on a monthly basis, you're buying on the high and the low of each month, because you don't know where the high or the low is. So you're actually going. And one of the things is, when the markets are down, that's when you're buying more shares. So always remember, that's the time to buy, because that stock is on a discount, it's on sale. So you're buying it at a discount, you should buy it. Again, given your risk, you got to have the risk tolerance. So, on that, I always say you need to have that emergency fund. So you're not going to your stock account, if you lose your job and you need to pay rent or the mortgage next month, but whatever you have extra, and with all the buckets have fulfilled, invest monthly in the stock market and stick with it. You're going to see ups and downs. We've had a decade of a bull run right now.
Yeah.
I mean, it's been amazing, but it has to give some time. I mean, for us, it's great, because every time we meet with clients, the accounts are up.
Yeah, everyone's happy.
Everyone's happy. But I've been in the business when we had the tech bubble, when people were not happy. I was in the business when the big, recession fell in that area, and people were not happy. So it's nice when we work with people in a decade that it's been up, but there are going to be down markets. So as long as you stick with it, there's going to be ups and downs. And if you look at it, it's where it is today in 2021. And if you're looking at this for 2030 or 2035, it's still going to be up. You might have a few years of down, but it will, it'll eventually make its way up. So just have a plan, stick with it, go monthly, as Colleen said. And yes, this is how you build wealth, is through the stock market, in my opinion.
Yeah, no, that's really
I don't know if I was supposed to say that or not.
No,
I agree.
This is your session to tell us how you feel, what you truly believe in. I love it. That's perfect. I mean, really, I think
risk. You got to have a risk. Not everyone can have that Tesla stock, when you see the volatility of that. So you got to have, go within what you're comfortable with. Yeah,
certainly. I mean, this process takes discipline and patience, right? I think someone in the chat just posted, time in the market trumps timing in the market. And I think that's really wonderful. Thank you for sharing that. I think that's a great way to sum it up. Thank you both. This is, I can't believe how many wonderful questions we had in the chat. And so I'm feeling overwhelmed and excited and wanting more, right? And actually, that's one of the things that just came through in the chat is we would love to have more sessions. Luckily, we do have more events in this series, and we'll certainly encourage everyone again to fill out that survey, because if there's still an unmet need here after this evening, we can continue the conversations. I also want to reiterate again that both Marjan and Colleen's contact information will go out to all attendees. So again, if you want to continue the conversation, and it sounds like people certainly do, because there's so many great questions specific to each of you this evening. So speaking of the next round of events, we do have 2 more events in the Women in Philanthropy series. So next Wednesday, April 22nd, we will host a transformative philanthropist and volunteer panel featuring 4 outstanding women. That panel will be moderated by President Bolton and a highly impressive class of 2021 student, Leslie Chinuri. she actually hosted an event just this past Sunday for the Create Her Day called, I think, Securing the Purse. So a very similar theme as our session tonight, which was wonderful to see a student who has actually done this particular research for her IS, talking to her peers about what it takes to be a successful investor and obviously save accordingly. Then the following week, we will have our final event. So on Tuesday, April 27th, we will conclude our series with an interactive conversation with women in the philanthropic sector. So this conversation is meant specifically to help build our network and support one another, and specifically make connections for our current students. So again, Marjan and Colleen's contact information will be coming. Please take the post-event survey once it comes out. And thank you again for joining, and have a wonderful night. Go Scots!